China's largest bank suspended gold trading within 3 days. The reason has finally been revealed. Overnight, the bank-based gold trading channels you're familiar with may simply disappear. This is not an exaggeration. Recently, several major Chinese banks, including ICBC and the CCB, have suspended their personal precious metals trading business. Strangely, while banks are closing this door to ordinary people, another door is quietly opening. The People's Bank of China is increasing its gold reserves globally at an unprecedented pace. On one hand, there's tightening. On the other, there's increasing holdings. What secret lies behind this seemingly contradictory operation? The title may sound sudden, but in fact, this transaction storm affecting major Chinese banks was not a sudden event. It had been brewing and laying the groundwork for several years. This is not just a simple risk control measure, but more likely a far-reaching strategy concerning the future of the RMB and national financial security. Today, we'll uncover the logic behind this layer by layer. Let's return to the event itself. This storm didn't appear out of thin air. As early as around 2020, many banks had already begun to take action to cool down the personal precious metals business by suspending new customer account openings and issuing risk warnings. This was just the beginning. In the years that followed, restrictions were tightened one after another. Recently, this tightening action can be said to have entered the final stage. Since June 2026, several banks, including ICBC, CCB, and the CMB, have successively issued announcements stating that they will officially cease acting as agents for personal precious metal auction trading on the Shanghai Gold Exchange starting in late July. Some banks are directly clearing out existing customers, requiring them to close their positions themselves within a specified time. For example, some banks have significantly increased the margin ratio for gold deferred contracts, also known as T+D products, with some even reaching 140%. This is equivalent to completely eliminating leverage, making speculative trading that originally aimed to leverage small amounts for large gains meaningless. So, what kind of gold transactions were targeted in this precision strike? Many people may misunderstand and think that banks have stopped allowing the purchase of gold. This is the biggest misconception. In fact, banks have mainly suspended two types of high-risk businesses. One is account precious metals, which is what everyone knows as paper gold. The other is acting as an agent for personal precious metal trading on the Shanghai Gold Exchange, especially T+D deferred delivery products with high leverage. These businesses share common characteristics: high leverage, high risk, purely online trading, and not necessarily involving the delivery of physical gold. At the same time, it is still generally possible to purchase physical gold bars or coins from banks or subscribe to gold-linked wealth management products or gold ETFs. So, do you understand now? This is not a ban on gold, but a precise risk isolation operation. The goal is very clear: to separate ordinary investors from the high-risk, high-leverage game of gold speculation. Banks no longer want you to use their channels to chase highs and lows like you're trading stocks, playing a high-stakes, high-leverage game. An era is coming to an end, the era when ordinary people could speculate on gold through banks with high leverage is rapidly coming to a close. So, what is the official reason given by the banks? Almost all the banks' announcements point to the same word: risk control. They stated that the international gold market has experienced significant price fluctuations in recent years, and these measures were taken to mitigate market risks and protect investors' rights. This reasoning is entirely valid. The price of gold fluctuates far more dramatically than the average person imagines. In the first half of 2026, international gold prices once surged to a record high before falling back quickly, experiencing huge fluctuations in the short term. In such a roller coaster market, leveraged trading can amplify losses infinitely. Today, you may be celebrating the surge in gold prices, but tomorrow you may face a margin call and lose everything due to a sharp drop in prices. For banks, this is not just a matter of customers losing money. The crude oil treasure incident in 2020 still leaves major financial institutions with lingering fears. In that incident, crude oil futures prices fell into negative territory, causing many individual investors to not only lose all their principal, but also owe banks huge sums of money, triggering a massive social dispute and reputational crisis. Businesses like Gold T+D, which involve margin and leverage, share similar underlying logic with futures trading. In the event of extreme market conditions, banks, as transaction channels and intermediaries, can easily be drawn into the vortex. Therefore, From a business logic and compliance perspective, cutting off these high-risk businesses and keeping ordinary investors who do not have the professional risk tolerance capacity out is undoubtedly the safest option. This does indeed protect the banks themselves and objectively prevents more ordinary people from being drawn into a brutal financial battle. But if the story ended here, it would be a gross underestimation of the bigger picture, because risk control may only be one side of the coin. What's really interesting is that when we look at the bank's trading halt together with another macroeconomic trend, a much larger picture emerges. This trend indicates that the People's Bank of China is continuously increasing its gold reserves with astonishing determination and scale. According to data disclosed by the World Gold Council and official sources, the People's Bank of China has set a record for continuous increases in gold holdings. As of the end of June 2026, the People's Bank of China had increased its gold holdings for 20 consecutive months, marking the longest continuous period of increase on record. In the second quarter of 2026 alone, it increased its holdings by 33 tons. This rate ranks among the highest among central banks worldwide. On one hand, commercial banks are discouraging ordinary people from speculating in gold, while on the other hand, state-backed funds are going on a gold buying spree. Is this just a coincidence? Many analysts believe that this is precisely the two sides of the same coin, and behind it may be a strategic layout involving coordinated efforts from top to bottom. Let's first look at the central bank's perspective. Why would it continue buying gold near high prices? Even amidst the significant price volatility, the core logic is generally interpreted as having 3 points. First, diversifying reserves to hedge against dollar risks. For a long time, dollar assets have accounted for a high proportion of China's foreign exchange reserves. Against the backdrop of escalating global geopolitical risks and the ever-expanding scale of U.S. debt, shifting some reserves from dollar assets to gold, a hard currency that does not belong to any country's sovereign credit, is an inevitable choice for diversifying risks and ensuring national financial security. Second, it enhances the credibility of the RMB's internationalization. For a sovereign currency to go global and become an international reserve currency, economic size alone is not enough. It also needs strong credit backing. Gold, as the ultimate measure of value and anchor of credit for thousands of years, can effectively enhance the international credibility and acceptance of the RMB. Third, the ultimate safeguard against the weaponization of finance. In recent years, financial sanctions have been increasingly used as a geopolitical tool. Converting overseas dollar assets into physical gold stored domestically can effectively mitigate the risk of assets being frozen or restricted in extreme circumstances. Once we understand the strategic intent behind the central bank's gold purchases for security, sovereignty, and credit, we can gain a clearer understanding of why banks have suspended leveraged trading for retail investors. This can be understood as a kind of strategic cooperation. Connecting these two clues, a bold deduction emerges. At the national level, there may be a dual-track strategy for gold. Under the national team framework led by the central bank, the goal is to accumulate as much strategic gold reserves as possible in a low-key manner, serving the overall interests of national financial security and the internationalization of the RMB. At this level, gold is a stabilizing force, a vital national asset, and its value lies in strategic significance, not in short-term speculative gains. Meanwhile, on the private track, regulators, through banks, are proactively reducing leverage and de-risking gold trading for individual investors. The purpose is likely to prevent excessive interference from private speculative forces in domestic gold prices and to prevent uncontrollable and drastic market fluctuations during a critical period of national strategic planning. At the same time, it also guides residents' gold investment from speculation that pursues price differences back to holding that preserves and increases value. Behind this may even lie a grander vision. Some analysts speculate that as the internationalization of the RMB deepens, a mechanism may be explored in the future that allows trading partners holding large amounts of RMB, such as oil exporting countries in the Middle East, to directly exchange their RMB trade surplus in China for physical gold that can be shipped back to their home countries through the Shanghai Gold Exchange. If this idea can be realized, it will mean that the RMB has the convertibility of gold to a certain extent, which will greatly enhance the attractiveness of the RMB because it provides a closed loop that bypasses the dollar system and uses hard currency as the final settlement method. This will undoubtedly have a profound impact on challenging the existing international monetary order. Of course, it must be emphasized that this is currently more of a logical deduction based on existing clues than an officially confirmed policy. However, it provides a highly persuasive macro perspective for understanding this series of seemingly contradictory operations. What are your thoughts on this major shift in the gold market? Do you believe it's simply a matter of risk control or a larger national strategy? Given this context, how should ordinary investors allocate their gold assets? Leave your thoughts in the comments section and let's discuss them together. So, let's return to our initial question. Several major Chinese banks have suspended personal leveraged gold trading, ostensibly due to risk compliance and to protect you from losing everything in a volatile market. The underlying reason may be a profound adjustment in national strategy. What does this mean for ordinary people like us? First, it is important to recognize that the era of using banks to leverage gold trading is indeed over. If you still harbor the mentality of getting rich quick through speculation, this path is basically blocked. Second, this does not mean that gold cannot be invested in. On the contrary, the actions of the national team have demonstrated the importance of gold in the future wealth structure. However, the way people invest needs to change. In the future, the mainstream channels for ordinary people to participate in gold investment will shift more towards lower-risk physical gold, bank gold accumulation programs, and gold ETFs linked to gold prices. Third, we need to re-understand the properties of gold. It is transitioning from a purely speculative commodity back to its essence as a ballast asset for long-term value storage and hedging against macroeconomic risks. In short, what regulators are doing is removing leverage for private gold investment, while what the central bank is doing is adding ballast to national wealth. The logic behind gold investment for ordinary people is being completely reshaped. Only by understanding this grand strategy and the changing role of gold can one find their own safe place in the future wave of wealth.